Tech Snippets Today with Joseph Raczynski.
All right, Will Beeson, founder of Uniform Labs and Multi-Liquid Protocol. Welcome to the show today.
Thanks, Joe. Great to be here.
I'm really looking forward. There's a lot to go over. There's a bunch of cool things that are happening in the world that I think are beneficial for mankind, right? For a lot of things that are happening these days. So let me tee it up this way. With the Genius Act now passed into law, and everyone from Deutsche Bank to Apple to Airbnb already paying attention, it's clear that stablecoins are fast becoming core infrastructure for next-gen financial markets. So today, we really want to get into why stablecoins matter and why it may mean what it means for banks as well as companies and even individuals going forward. So, Will, I really would love to hear more about your background, where you started, how you got into this sort of thing, and what you're doing right now.
Sure, Joe. Thank you. Thank you. Well, thanks again for having me. Great to be here. Let me give you the very brief background, and we can dig deeper on any point. So, started my career in traditional investments, like many of us in the space, and then about 10 years ago, got into fintech. So I had my light bulb moment in about 2014 with respect to how modern technology can help upgrade financial services. And what that meant in 2014 was cloud, mobile, and APIs. And we set out to build a brand new bank, what in the US would be called a de novo bank in London.
Huh.
A bank for small and medium-sized businesses to effectively address the funding gap for that part of the economy. This was still post-global financial crisis, post-Basel III. Large banks had a very difficult time profitably servicing small and medium-sized companies, so they basically pulled out of the space. And we thought that by using modern technology, we could build a bank on web, on mobile, that didn't have branches, didn't have excess headcount, and therefore allowed us to go down market from a company size standpoint, make smaller loans to smaller companies, but without the same cost overhead, and profitably service that space. That thesis played out exceedingly well. The bank is called Allica. It's doing great today, one of the fastest growing European tech companies. And post that, I moved back to the US, connected with a different co-founder. We built a neobank in the US. And then in 2022, I joined Standard Chartered to build out a new business within the group to originate and issue ultimately securities, financial assets as tokens on public blockchain.
Hmm.
We did a lot of work throughout the group in terms of integrating with services and functions across Standard Chartered, things like securities custody, things like the core bank payments, and even started to get into distribution. How we effectively help replatform a traditional securities business, a traditional bank, into a future of on-chain financial markets. We can get much more into that, but during that period, we worked with Wellington, one of the largest U.S. asset managers. We issued a tokenized money market fund together with them, rated AA by Moody's and AA plus by S&P. So a squarely investment grade asset that you can buy in a MetaMask. Or similarly in an institutional custody account with many advantages versus traditional securities. And ultimately, I think what those advantages center around is 24/7 instant settlement in financial markets. So moving away from a world in which cash and financial instruments transact and settle T+1, T+2, sometimes longer than that, and moving to a world where value and financial assets move at the speed of the internet. I think we can finally bring the economy into the digital age through what the infrastructure that we're building. And now what Uniform Labs is doing with the multi-liquid protocol is creating effectively a settlement venue where money market funds, effectively cash equivalents, risk-free assets on chain, and cash in the form of stablecoins can interact, can transact, and can settle 24/7. and we're working with a range of different institutional partners to deliver that service across the financial ecosystem.
Fantastic. And I appreciate you actually describing what the organization's working on and what you're building towards. So, how big a deal in your mind was the Genius Act being passed? I mean, it sounds like you were ahead of the curve a long time ago, but did this really bolster the movement and the idea towards moving into this space?
So a huge deal for sure. To your point, I mean, even the way that we had structured the business pre-Genius, and we started this business at the beginning of the year. I'm not. I suppose there had been drafts of Genius maybe that had been circulated under the previous administration, and maybe didn't get as much traction. But regardless, I think it was clear to those in the space what the direction of travel was going to be, and not because of political whims, but because frankly, this is what makes sense. You know, if you're going to build a well-structured, well-regulated economy in which digital cash in the form of stablecoins exist, how would you want high-quality cash instruments to be structured? They would be fully collateralized. They would be subject to some sort of regulatory framework, in the same way that any financial product that touches consumers benefits from financial protection. You would expect the same thing to exist in stablecoins. I think what was useful to have enshrined into law is the permissionless on secondary nature of stablecoins, i.e., uh, in most cases, institutions that are involved in the minting and burning of stablecoins, i.e., the sort of primary issuance and the primary redemption of stablecoins, are subject to KYC and onboarding. But once a stablecoin has been minted, once it exists, it can permissionlessly transfer
Hmm.
between users. That ultimately is what delivers more of a cash-like experience versus a securities-like experience where every single holder of every single asset has to be on board. So I guess to synthesize, the direction of travel, I think, was clear to those operating in the space. There were some open questions, including around yield payment, which was called out specifically in Genius, i.e., issuers of stablecoins are, per Genius, not allowed to pay yield on to the end holders of stablecoins. Now, there's some nuance there, which we can get into. But broadly speaking, direction of travel was clear previously. The huge unlock, though, I think it's two things. One, it the formalization of the framework allows institutions to really get involved in this space. So that's probably the biggest unlock. It effectively, stamps stablecoins as a part of the financial system, as opposed to arguably something that had been operating outside of it. And secondly, I think it shows the views of the current presidential administration and even Congress in terms of providing a supportive, innovation first landscape in which people building in digital assets in responsible ways can confidently move forward. So huge for both of those reasons.
No, wonderful. Thank you for articulating that. That makes a lot of sense to me. So, one of the things that sort of popped in my head while you were going through that is this idea of what was once a central bank digital currency, so CBDC. And originally, I thought that would be something that would have taken off, but now it has certainly a lot of weight behind it in the sense that people do not, in general, want to see that because they see it as sort of authoritative, right? And so government could see into everything. Do you think that that's why it's not something that the government wants to take on versus a privatization of money, which is what we're seeing right now with Circle and with Tether and all the other ones that are, I mean, there's going to be tons that come into this, right? Which I'm also curious about, like why so many. But so first and foremost, why do you see that central bank digital currencies was not a solution? And this is more like hypothetical. Why do you think that didn't take off?
Yeah. I, Look, I think it's a great question, and I think there are probably a few reasons. So one, which you highlight in the U.S., it was I suppose early on identified as potential for central abuse, i.e., a surveillance mechanism. If every transfer of value is traceable by the government, is that a world we want to live in? So I think there's a theoretical argument against that. I think that though at the same time, and here I'm speaking from 10 years of scars having been building in financial innovation, it is very hard to change the financial system. There are certain things that can be achieved through regulation, but changing consumer behavior and changing the behavior of large institutions is extremely difficult. So I think regardless, the broad adoption of a new form of money issued by a top-down organization would have been extremely difficult to begin with. I have similar questions about tokenized deposits and wholesale CBDCs, which are other versions of tokenized cash. I think ultimately, what we've seen, is with stablecoins is the classic story of the 10, 12-year overnight success.
Yeah.
Stablecoins, I think were first introduced basically so Bitcoin traders could arbitrage different crypto exchanges, 10 years ago.
Hmm.
And it's only now that we're actually seeing levels of adoption that merit mainstream discourse. So I think the idea of someone drafting a bill or introducing a retail central bank digital currency and expecting money to change from one day to the next is extremely unlikely in any case. I think it'll be interesting to see how it develops in other countries because other countries don't have the same views that we do in the US. Europe, for instance, is pursuing a central bank digital currency. I have lots of questions, I guess, about the ultimate success of some of those projects.
No, totally fair. Uh, so along those lines, do you think that we're going to see just this deluge of banks, others creating these stable coins? And why would we need 100, 200, 300 different stable coins? What's the point? I'm just kind of curious
Yeah.
from your vantage point.
So I think the simple answer is yes, we will see a large number of stablecoins. And the simple reason is kind of from a game theory standpoint, there's economic incentive, or at least perceived economic incentive, for many firms to issue a stablecoin. There's effectively zero downside or reasons that they wouldn't issue a stablecoin. And there's nothing, the hurdle to issue one is quite low. Meaning, I think naturally you end up seeing a large number of stablecoins being issued. Now, does that mean they all get adoption? I think absolutely not. We've done a lot of work on this space in general from a sort of strategic and competitive standpoint. I think it's pretty clear that the ship has sailed on a sort of unregulated stablecoin for emerging markets, i.e., Tether. I think the ship has sailed on a more regulated institutional dollar equivalent, i.e., USDC. I think the go-to-market playbooks, like the reasons that those stablecoins were able to get such meaningful traction and indeed continue to scale today, effectively become the standards in different swaths of the digital assets economy, is because they were operating in a greenfield space. And I think those opportunities are gone today. I think that the playbook for new stablecoins will need to be different. I think we're seeing firms that have large customer bases. I think Walmart and Amazon have been in the news as considering issuing stablecoins. I think there's an open question around exactly how that can work. I'm sure there's a path for it to work if desired. I think the risk is companies viewing stablecoins as a sort of new rewards system. I'm not sure that is ultimately a viable model. I mean, what we're talking about are, one-to-one dollar equivalents.
Right.
And as a result, I think we need to be clear on what the value prop is and how they work in terms in order for specific stablecoins to gain adoption. And then final point, obviously all of this is hypothetical at this point, and it's expectations projecting into the future. But I do think it's likely that one or two or three stablecoins will end up becoming the de facto winners in certain verticals. So it's possible that B2B cross-border payments, there could be one or two or three stablecoins which do the lion's share of the volume. I think it's possible that in the internet economy, one or two or three stablecoins could do the lion's share of the volume. I think it's also possible, and in fact likely, and more likely the more stablecoins we have, that the stablecoin itself and even the branding of the stablecoin, is it USDC, is it USDT, is it a stablecoin issued by Stripe, or even
PayPal. Yeah.
potentially
Yes.
PayPal. I think it's possible that the stablecoin itself moves to the back, and it's kind of piping, and ultimately it's abstracted away by the orchestration layer, by the consumer facing layer, and perhaps people aren't even aware in real economy activities which stablecoin they happen to be transacting in.
Just like TCP/IP and blockchain, all these things. Yes, I think that makes a lot of sense in time, no question. So you kind of led us down the path, perfect path, in my opinion, of talking about use cases. What kind of use cases are you seeing or hopefully will see in the not too distant future?
With respect to stablecoins, I think there are a few different use cases. One is squarely within the world of digital assets markets. Probably won't go super deep there. I think it's very relevant, but I think it's specifically relevant as digital asset markets converge with traditional financial markets. So that's really the shift that I think we're in the process of seeing. I think that's why Genius was so relevant. I think that's why Clarity, or whatever the resulting market structure bill ends up being called. So effectively, we've talked about crypto markets as being completely distinct from traditional financial markets to date. Though I think it's very clear at this point in time that the two are converging. We've seen announcements from the likes of Robinhood and others about tokenized stocks looking to bring equities on chain in tokenized form. I think it's clear to everyone in this space that ultimately the only way for financial markets to really run on chain is for securities to be issued natively as tokens rather than being wrapped or redeployed as tokens. And I think it's just a matter of time before we start to see that. At Standard Chartered, one of the things we were focused on was working with sovereign issuers who issue government bonds to consider issuing them as token native instruments because there are a range of benefits, especially for emerging countries, about issuing token native bonds as opposed to traditional bonds. I think I interrupted you.
No, no, no. I appreciate no. I think this is excellent, and I really want to understand a little bit more from your perspective as sort of like the tip of the spear in pushing these things forward within the banking industry for so long. How long do you think it might take before we start seeing securities issued on chain? I mean, are we talking 10 years out? We talking 5 years out? What do you think it might be?
I would be surprised if we don't see a native sovereign bond or equities issuance on chain within the next 18 months.
Huh. Okay.
I think it's easy to look out at the space now and say this is the beginning, but actually, firms have been working on this now for a few years. I have personally been involved in conversations with national treasuries, central banks about issuing token native bonds, as far back as probably 3 years ago at this point. So obviously, it takes time for such innovative technology to be adopted by governments. But I think that, point is, I think those conversations are already progressed.
Okay, that's great.
Yeah.
It is.
And
Sorry.
so that kind of gets back to the use case, which is ultimately replatforming financial markets on upgraded backend infrastructure. So I talked about my experience in fintech before, and I suppose if upon reflection we're being honest, what we did in fintech in what I call the first cycle, so the kind of 2008 to 2021 era, what we did was we upgraded the front end of financial services, and we did a lot of work on the sort of middleware orchestration layer. But no one was able to make meaningful inroads into the real back end of finance. There were many attempts to replace Swift or replace the banks, as far back as 2011, 12, 13. None of it ever materialized. TransferWise is an incredible business, but it has not taken any meaningful market share away from Swift. As a result, transfers of currency still settle in multiple days when you talk about cross-border payments, or when you talk about USD payments in the US. But now, for the first time, we're really able to upgrade the backend infrastructure because it's a fundamentally different structure, from having what was originally servers on premise to having cloud-based infrastructure for financial services to having effectively one shared ledger on which all value and all assets are instantiated, and as a result of which all value and all assets can instantly interoperate, i.e., can be traded and exchanged atomically 24/7, around which software can be built to actually automate all of these value transfers and exchanges. And another key characteristic of this shared settlement layer is that any new firm or counterparty that connects to the settlement layer now has access to every single asset and representation of value on that settlement layer. So no longer is a certain bank deposit only available in the confines of a certain bank, or a certain asset only available via access to a certain CSD or exchange. Now every single asset and every single representation of value which is instantiated on the shared ledger can be accessed by any party who's connecting to the shared ledger. And these few things, nuanced and technical as they sound, are actually transformational in terms of how the financial system, specifically financial markets, will work going forward.
Very interesting. So I'm trying to read between the lines here, and tell me if I've read too far in between. And that is, do you think that banks are going to be impacted dramatically in any way, in the sense that hypothetically now you could go bankless, or going forward could go bankless if you decided to go down that road? Um, do you think that will have an impact? Do you think people are going to move in that direction, or no, because it's something, it's an institution that needs to be there for whatever reason?
All right, so I think I have two answers to that question. One is around the edges for certain customer segments, absolutely. So we're already seeing fintech apps that are not running on banking infrastructure, but are running on stablecoin infrastructure and digital assets infrastructure instead. So I mentioned when I moved back to the US from Europe, we built a neobank here in the US. That meant partnering with a bank of record. It meant partnering with Visa for card transactions. Ultimately, customer deposits were held FDIC insured by our partner bank. All of the BSA, Bank Secrecy Act requirements were met. All of the compliance was flowed through to the service that we ran, and all of that was subject to the ultimately legacy infrastructure that banks run on today, which meant it was very brittle, it was difficult to implement, it was costly, very time consuming. You can build that same offering, which was effectively a consumer banking app, checking, savings, card, payments. You can build that same offering today on a stablecoin stack. You're not therefore subject to the legacy tech, the cost structure, the risk posture of a regional U.S. bank that's in the business of supporting fintechs. You have much more flexibility and cost efficiency in delivering that service. And ultimately, what that means is that the user of that service has what feels like a checking, savings, debit, credit account, but it's all running on stablecoins. The
Yeah.
experience for them is exactly the same. The back end is different. So that we're already seeing, and that will, by definition, move some banking away from traditional incumbent banks. I think the open question, at least in my mind, is around credit creation. And again, not to get philosophical, but
Please
you
do.
know, one of the roles of the central bank plus commercial banks, kind of two-tiered monetary system, is that commercial banks can create credit. So, banking license is effectively a license to print money. You're able to make a loan. I think there's a general misconception in the world. It's not that people deposit money with banks and then banks actually lend out those dollars to other individuals. The two functions are completely separate. When a bank makes a loan, they're creating new dollars.
Yeah.
And if a bank loans you $1 million to grow your business, they're creating $1 million new and crediting them to your account. So that is actual new money creation, and then they back off to the central bank for reserve management. That also allows that system is connected with the treasury market, so that the government can increase and decrease the money supply in the economy to solve for things like economic cycles. In a fully collateralized fiat-backed stablecoin world, you don't have all of those same tools. The sort of classic central banker toolkit does not exist in the same way. I think there may be new tools which emerge. Stablecoin issuers are likely to be large buyers of short-term U.S. treasuries. But point being, credit creation is something of an open question in my mind in a stablecoin only world. So I do think that there will be a continued emphasis, at least on large banks, GSIBs, to participate in the credit creation process. So I guess that would be my short answer to your question.
No, that's fantastic, and it makes a lot of sense to me. Maybe the last question I have really revolves around, I guess, some risks. I think we've heard the benefits that are there for developing open architecture, institutional liquidity platforms, but do you see any risks now, or are we okay at this stage?
So I suppose there are always risks. I think at this point in time, the risks are theoretical. So projecting forward, I think if we continue on this path, there will be more and more meaningful risks that we should take on board, which we should consider, and which we should ultimately solve for. Um, I think that one of them relates to speed of money. We saw with Silicon Valley Bank, for
Yeah,
instance, effectively the fastest bank run
withdraw. Yeah,
in history. And that was in a non 24/7 instant settlement stablecoin world. That was without software programs built on top of transfer of value, which could literally instantly drain, or at least move value, move stablecoins from one place to another. So I do think that there are considerations there. Now, I think that's inherent in a fundamental upgrade to the system, right? Like it's difficult to say that being able to access your money from a struggling financial institution faster is a problem. That's obviously not a problem. That's a huge benefit.
Yeah.
However, there are implications vis-a-vis the way that the current system is designed that we should think about. That's one. I think to the extent that the I guess what's the right word? Tether is the largest stablecoin issuer. Circle is the second largest stablecoin issuer. There's a high degree of concentration among the issuance of stablecoins today. We're at 250 billion plus of stablecoins in issuance. If that becomes 2.5 trillion, and we're still at the same levels of concentration, then I think there are meaningful risks to the system. These are, at the end of the day, private companies. I think even Genius does not provide a truly comprehensive approach to incorporating stablecoins as a replacement for cash into the global economy. For instance, something like the FDIC, does not exist for stablecoins. Now they're fully collateralized, so you could argue, does it need to in the same way? But point being, I think concentration as the amount of stablecoins in the ecosystem grows is important. And then I guess the last point is just ensuring access to all users of the financial system during the course of this transition.
Really interesting. Yeah, I think one of the things that came up when people were working towards this a while ago is that it had to be like a one-to-one backing, right? So if there is a bank run, and I wrote a piece about this 3 or 4 years ago, and it was like, you could see it eventually coming where if there is some FOMO or something happened, people need to withdraw very quickly. And if it's all completely liquid and that easy and it's 24/7, then boom, you could just remove things and all of a sudden it'd be like a run. But if it hopefully is backed one-to-one, then we shouldn't have a problem. But that amount of money being shifted that quickly from one place to another is it's unusual for us traditionally. So that's why I think it's fascinating to think about as a possibility. Hopefully not, but usually these things do happen. So well, my goodness, Will, thank you so much for imparting all these amazing concepts and ideas and what you're working on, sharing with us that as well. It's been fantastic. So I really appreciate your time today.
Yeah, thank you, Joe. My
Aw-
pleasure. Great chatting
Awesome.
with you.
Tech Snippets Today with Joseph Raczynski.